I'm going to look at politics, the economy, tax, debt and inflation. I have 10 minutes, so I had best crack on. Reading the report yesterday, my first feeling was, what planet is Rishi Sunak on? Yesterday he spoke of a new age of optimism. He boasted about world-class public services. Meanwhile, we seem to be living in the middle of a cost of living crisis. Nobody can seem to see their GP. And in business, people I'm talking to are talking about electricity prices spiking, doubling since last renewal, import costs skyrocketing, wage costs hiking with the new minimum wage, corporation tax up to 25%, and import costs out of control. So I normally only look at the appendices of these documents, but I did look a bit closer this time. The contents page I thought was very instructive. Levelling up was mentioned 92 times in the document. That's basically once every other page. I think that language is very important. And when you're constantly talking about levelling up, it surely implies that you are levelling something in the first place. When you're talking about building back better, it implies that something has been flattened, something has been destroyed, meaning you have to build back rather than actually wanting to build back. And that's what I think we see in the politics. It's very relevant, I think, that Michael Gove's new title is the head of the Department for Levelling Up Housing and Communities. Something quite yes minister about that. Gove is famous in Whitehall, of course, for banging heads together and ramming through his agenda. So I guess this whole thing is important to government. Personally, I think the slogan is a bit politically problematic because it has a sniff of let's take money from the south and give it to the north. I suppose we will see if I'm right at the next election. But for now, what exactly has been levelled? Well, the answer is the economy, or more precisely, the policies to deal with COVID. If you look at the rolling GDP figures, you can see how badly the economy tanked in March 2021. 20-odd%. Now, unprecedented is one of those terms that's used ubiquitously these days, but I think it's relevant in this case. This chart tracks back to 1956, and even the 2008 credit crunch is a mere wobble in that trajectory. The problem with shocks is that they test resilience, and I keep coming back to this word, resilience. The economy of the last 20 years has been based on just-in-time solutions, supply chains, propped up by what I think is a one-time event. When China joined the WTO in 2001, that was a one-time event where the world got this cheap workshop. This event is not going to happen again in our lifetimes. Now, perhaps you're sensing a bit of irritation in my voice. This set-piece jamboree has come mid-half term. Personally, I've not been feeling particularly positive about it. Haven't we had enough major changes to the tax and spending regime already for 1 year? Corporation tax, as I said, already up to 25%. That reverses the last 12 years of steady reductions. More national insurance or health and social care levy, if you want to call it that. And spending. The deficit at the highest level outside of wartime. I mean, the 70 billion quid spent on the furlough scheme was just part of the 320 billion spent on COVID altogether, with more to come, a lot more. And much of that has been done on the nod, without thought to a budget. So, what is the use of 3 pence off a pint in the context of all of that? Now, unless you're in that sector, of course. So this headline on Twitter a couple of days ago took my eye. Unions and MPs of all parties urge Sunak to boost household incomes. Quite so, I agree with that, but nobody ever seems to suggest cutting taxes, which of course would do exactly that. And that is a good point to make at this time. This was in the press yesterday. The so-called party of low taxes is now not just responsible for a tax raid, but a sustained tax raid. You can see from this OBR chart, they are saying that the overall tax burden is going to be the highest since the Second World War, 70 years ago, 36.2% of your money taken out of your pocket. Now, I know the line from the Chancellor yesterday was that he does not like it, but if he doesn't like it, why has he done it? I'll leave you with that thought. There is a serious and less rhetorical point to make here, which is it's not as if the UK was blazing trails with its GDP before then. the decade before the last 18 months. Back in the good old days, when we'd stand on this platform, we would talk about things like the productivity puzzle. Why was GDP growth so elusive? And we talked about the shadow of the 2008 crisis. We used to talk about things like the lack of capital investment, over-reliance on imported labour, a shift to a service-based economy. We never talked about putting up taxes. That is the one way you kill an already flat economy. So it seems to me that my concern that the size of the state and the number in the public sector payroll will make any sort of future tax cuts more and more unlikely. And it feels like we've kind of crossed a tipping point, crossed a Rubicon. And it got me thinking of Gerald Ford's, the old US president, his contrary economist, a guy called Arthur Laffer, who some of you might have heard of. Laffer set out this wonderful, easy thing on the back of a napkin. Literally, he drew this on the back of a napkin, which was the idea that the more tax money that's taken from business, from each dollar of income, the less money that business would be willing to invest. He argued that business would find ways of protecting its income from taxation, or even relocate part of its operations to achieve the same. I think that Laffer's hypothesis from the 70s is further exacerbated by our data-driven economy. I fear we've already passed T-star on that diagram, strolling across the summit of the Laffer curve, as Robert Choate put it when he headed up the OBR. So if tax can be thought of as government's income, and we're beyond that kind of peak tax, what about debt? You'll recognise this slide. I used it back in March, and like March, I've sort of added to it at the end there to sort of show what was announced yesterday. And you can see yesterday's forecasts have gross debt as a percentage of GDP normalised at a pretty flat 95% for the coming 5 years or so. Look at that flat period between 2010 and 2018, the Cameron-Osborne period of so-called austerity. There it is in the table, and we had about 85% debt as a proportion of GDP. So that's going up to 95% per the forecasts. What that seems to me is that extra 10%, you could think of it as a COVID baked-in increase in there is baked in now. And I think that's a problem for Rishi. I go on about debt a lot. I bore my partners about it. But it's a problem of resilience in the system again. We, in my profession, we often get asked to stress test things in financial models. Now, if we stress test interest repayments and think of it in very back-of-an-envelope type terms, if your debt, as the UK debt is 2.2 trillion, then a move in rates from 0.1 to 0.25, that costs you another 3.3 billion quid per year. If you add a percentage point onto interest rates, that's 20 billion pounds. And 1% is not that high, really, in historical interest rate terms. But that would blow this budget completely out of the water. The reason I go on about debt and service charges on debt is because it is contractual. That's the difference with a government bond. If the rates you have to pay back goes up, you have to stump up as a government. It's not like a promise of raising taxes or not raising taxes that you can break later. It is an obligation to your creditor. As Jason said, the Bank of England monetary policy meets next week, 4th of November. Keep an eye on what they say. Speaking of the Bank of England, here are their inflation forecasts. Now, this is from back in February this year. I think they call these fan diagrams. I have a more Anglo-Saxon name for them. It is a forecast any use when you're saying it could be between -1 and +6. Would your FD accept such projections? Mine certainly wouldn't. But I do have some sympathy for the Bank of England, and particularly for the former economist there, Andy Haldane, who was in charge at that time. His dilemma was understanding mixed monetary messages and an uncertain situation. And I think of it a bit like a seesaw. And that's why he could only ever produce that fan diagram. And the easiest way to think about this, a very simple example, is the hospitality sector. We've gone from eat out to help out, hugely inflationary, to no vaccine passport, no service, hugely deflationary. Very, very difficult to set forecasts and policy as a bank governor against that sort of backdrop. One of the headline grabbers from yesterday was the inflation forecasts, expected by the OBR to hover around 4% next year. I think it's going to be higher than that because I don't think they properly factor in the gas shortages that we're expecting for energy bills later this year. Again, it seems like just the wrong time for the tax take to go up. And instinctively, my black line on that diagram there, what I've done is I've sort of drawn a line through Andy Haldane's projections with what was forecast yesterday. And what that shows, that inflection point around 2022 just feels wrong to me. And here I like to think of the great economist Friedrich Hayek. He famously described trying to control inflation as like grabbing a tiger by the tail, a similar sort of analogy to the seesaw effect that I mentioned in the diagram a moment ago. Yesterday's forward forecasts are no real better than that Venn diagram. And you can think of the COVID shock as that initial grab of the tiger tail, and then you have this binary effect. It will swing that way or it will swing that way. Runaway inflation or depression. I just can't see a smooth black line being navigated as being forecast yesterday. You know, where is the fiscal room with tax takes so high? Where is the monetary room with what I said a moment ago about the impact of increasing interest rates on the budget? Doesn't seem like the room is there. And this is one of my favourite charts as well, which gives me further doubt about it, is that central banks have historically just proven incapable of executing a more modest increase to interest rates over the years. They always leave the monetary punch bowl out a little too long at the party. I don't go anymore, but for more than a decade, every quarter I would go to their updates, and every quarter they would model interest rate rises imminently, and every quarter it never actually materialised. There is instinctive real-life wisdom in what Hayek says. One of his great quotes is, "The results of an individual's efforts are necessarily unpredictable," and he's absolutely right. This chimes with our real-life experience. Certainly, anecdotal comments to me from our friends at the port nearby here suggest that the current disruptions look like continuing on into late 2020 and probably even later than that. And that is what Hayek was essentially saying. You cannot model individual behaviours, emotions, buying patterns. You can think of 7 billion world population running all over that inflationary seesaw. Indeed, the forecourt of the petrol station in my rural village a few weeks ago was essentially like a scene from Mad Max. It was only Tina Turner running around with a machine gun that was missing. That was not predictable, and that is just a small part of our supply chain. Let me try and conclude with something optimistic and with an analogy. I don't think it's hopeless, but we do need to separate value from price. And let me explain exactly what I mean by that. When we get asked, as we frequently do, to value a business, we have to explain to our clients that there are but 3 drivers to a hypothetical valuation exercise: cash flows, growth, and risk. Price is an altogether different concept. And if you are into religion or if you watch films, you will know that there are probably 7 real emotions that drive what price is all about. How much do you pay for a Banksy? How much do you pay for Newcastle United? The answer is you pay what somebody will pay. It's not based on those valuation fundamentals, it's based on emotion. So if we think of those concepts in terms of UK PLC, you can see I have argued today that the fundamentals on the right are not particularly good. Cash flows, tax looks maxed out. Growth, you've seen it, it's anemic. GDP over the last 20 years. Risk, we're still talking about COVID and Plan B, Plan C. Plan B, 18 billion quid is what's been quoted for that. You know, that's more than 350 million pounds a week. And you remember the trouble that caused when it was put on the side of a bus. So the fundamentals are not good. The price drivers on the other side is all about rhetoric, which is nothing to do with the fundamentals. And some of my colleagues have covered some of that stuff earlier today. I can't tell you which of those will win out. I do understand that a 2023 election is on the cards earlier in the Parliament than later. People will be asking, has my life got better? Are my prospects better? Are my finances better? I guess if the answer is no to those, then we may see some acceleration of other tools of governance. I mentioned there, look out for digital currency. I'll talk about that in the breakout room and what I mean about that. But for me and you, as in both of us in business, this is all macro stuff. We're limited what we can do in this unprecedented time. It feels pretty authoritarian to me in many respects. What we can do, keep calm, keep rational, focus on those value drivers that may influence and we can influence. Thank you very much. Hope you've enjoyed it. Jason, back over to you.